Yeah. Two. Yeah. Aye. I'm jacking the beat, you calling the cops. The yapping is cheap, I call you the ops. The rapping is heating, it's all cause of pop. You get a leak for the ball, get a drop. Feel like I'm wrong when I double it back, cause I'm making it harder to catch that. But I covered the ticket, I call you to visit. You tipping and hit up the cash app. Baby girl, been round for it, yeah. In the old days, I was stuck in old ways. Never really trying to flip the old page. Young man tripping at an old age. Thinking I was flicking, had a low wage. Led the bro days, then a slow praise. Thinking it'd be different, it would gon' change. Then it really didn't, it's a cold game, yeah. Ay, all I really wanted was the money in the pocket. Got over money, but the money ain't a topic. Like Bill Doe and the money gotta stop it. Kid need food and the whip need juice. I'ma get these views when
What's good, baby? It's your boy Dale. I'm back in the saddle again. Our motto is to buy, build. We already bought it already, so we already own it, free and clear. Refinance to long-term debt, cash flow. That is the motto. Cliff, man, is that a pretty strong motto, man? What do you think?
Man, the model is strong. Like, you're getting each piece of the invest, right?
What it do, baby? It's your partner Dale, looking old, so fresh, cold, clean. You see that thing, guys, and take that picture for your mom and them, guys, and welcome to another edition of Real Estate Friday with your partner Dale. Normally, I got my partner in crime, Cliff, here, but Cliff right now is taking care of some business for your partner, so it's just gonna be me. It's all good, baby. I still, by myself, look better than you, y'all. But man, let's get into this thing, man. Thank you so much for the time, guys. We're gonna dive right into this thing. We're going to get in and we're going to get out, y'all. We see Red Pill is here. We see Stevenson Mack is here. Y'all, thank you so much for blessing me with your time, guys. I pray I get you some value, guys. On this one, let me tell you this. This is going to be the one that you're going to want to get your pen and pad out, guys. This one right here. It's going to be kind of a master class type of scenario when it comes to this, all right, guys? And we've had a lot of things go on when it comes to what's going on in the real estate industry right now. So we know how we jump into this thing. We jump into the current market analysis, guys, and we know what actually happened today. Actually, yesterday, we actually had the Fed chairman come out. He actually came and said that the Fed did pause the interest rate. So the Fed did pause, and on my bad, I actually committed a sin on my standpoint. Yes, I got the bag. Yes, sir. Every week we got to get that bag. But let's get back into it. The Fed actually paused its interest rates. All right. Now, what does that mean? Is it good? Is it not? Let's go and revisit and let's see what the media is saying about what's going on. Let's hear what the Fed chairman said. And then we're going to see the effects of what the different media is actually saying. They're going to kind of sit down and infuse some wisdom to this thing. So let's dive into it, guys. Let's go and see exactly what's going on here and see what they're saying about what's going on with the Fed pausing its rates. Let's see what's going on. Here we go.
As we reported earlier, the Federal Reserve Wednesday decided to leave interest rates unchanged. The Fed has raised rates 11 times since March of last year in an effort to bring down inflation.
Now, that is a lot of rate raises, 11 times since last year. I believe that's the most ever. All right, so I'm stopping and pausing this to give you some context. Let's keep going.
Inflation rate, in turn, has fallen to less than half of its peak in June of 2022, but it remains.
Stop right there. That's because they actually changed how they calculate the inflation rate from it being every 2 years to actually being every year. All right, just give me some context around these numbers. Let's keep it going.
At higher than the desired level. For more, let's bring in CBS News senior business and technology correspondent Jolene Kent. So nice to have you here.
Great to be with you, John.
Why did the Fed do nothing?
The Fed did nothing because it believes that it can continue to cool off this really hot economy by staying put. And also with bond yields.
She's saying it's a hot economy. A hot economy. She needs to find out what hot is. Because if what I'm assuming she means by hot, it's roaring. And you're going to hear her unpack it a little bit, and you're going to understand the context about what she's saying. You be the judge is what she's saying is correct. But again, this is the media spin, and you're going to get two different spins here. Okay, here we go.
Up so high, that's also helping cool off some of that vigorous activity. But
Vigorous.
the economy overall is really strong right now.
Economy strong.
Inflation continues to persist. They think by holding off, but reserving the right to do it in December, that this might accomplish their goal.
And now stop right there. If you got to understand, bring me a little closer real fast, guys. If the economy is roaring, right? That's again context. If the economy is roaring, why is the Fed kind of really see what they're going to do in December as well, right? If it's roaring, right? So it's not making any sense as well what she's actually saying. So again, context of what's going on. If it's roaring, why do anything at all, right? So again, context. Let's keep it going. Let's see what she's talking about.
And is that the signal that Powell sent? So, of course, just to remind everybody, there's what the Fed does, and then there's what Powell says, which everybody then interprets in 1,000 different ways. What was the consensus interpretation of what the Fed might do in the future?
The consensus interpretation is that the Fed is thinking about this very carefully, and they are continuing to think about what they will do come December, because their goal for inflation is to reduce that rate of growth back down to 2%. And they're not there yet. And it will continue to take possibly another hike.
Again, me and Cliff talked about this 2% goal. That ain't gonna happen. That's a pipe dream. That's a marketing ploy. Okay, it's not gonna happen because until Congress stops printing so much money, it's a pipe dream. Let's keep it going though.
Hike and then sustaining this level of expensive borrowing to get it down there maybe sometime next year.
You spoke to a small business owner about her company and how this, you talked about borrowing costs, how this
look at that Fed funds rate.
Her. What did she say?
Real world.
Denise Duncan in Pomona, California, makes industrial strength dust collectors. And what she wants to do is expand her business. But because it's so expensive to get a loan right now, she can't do that. We went out to Pomona to her manufacturer.
Stop right there. Stop. She just killed her whole premise. If the economy is roaring and it's red hot, why is an entrepreneur that's looking for growth capital not able to get growth capital because it costs too much? The cost of debt, it costs too much. I thought the economy was roaring. So she's kind of convoluting her own point from the get-go. It's not making any sense, but let's keep it going, guys. Let's see exactly what they're talking about, guys. Let's get it in.
Manufacturing floor, and this is what she told us.
Gas, trash, my utilities have all gone up.
Look at
my insurances have gone up by 22%.
Wow.
Tell me what you've had to do to accommodate for these costs. You got to raise prices, which makes me even less competitive.
See, that's what happens when it comes to inflation. And what inflation does is very simple. Whenever inflation is actually present, what happens is they cost the producers of the product or service, it costs them more to make or produce that service. So what do? They pass that cost on to the consumer. You just heard someone that say that they actually had to charge more. And she's talking about she's struggling to grow a business in this economy. But I thought it was roaring. I thought it was red hot. It's not making no sense. All right. I want you to kind of see the spin here. Then we go to the banking side in a second. Here we go. Let's get it in.
And the other thing I think that most people don't understand is if I can't pay the rent or the utility or my payroll, I will do without. I will do without the paycheck.
Now, Denise has gone without a paycheck 3 times in the
That's
last 18 months. This is a woman who's not only a business owner, but she's caring for her family, her aging grandparents. She's dealing with inflation in her groceries and her gas bills as well. And so what she wants is a rate cut. But she's not going to get that for a long time. And so she's really trying to have to cover her bases. And we're seeing that throughout, whether it's an industrial manufacturing company, a bakery, all over the small business landscape.
So let's stop right there, guys. Stop right there. When it comes to what she was talking about, let's go to what it says, where's the economy going? When it comes to what she's talking about, she began the diatribe of when she was actually on CBS talking about how it's a red hot economy, it's roaring, but she didn't hedge and then said, but the Federal Reserve, the Fed chairman is saying, let's see how it looks in December. right? So there was a hedge there on what she actually outlaid up front. Then the real world came in. So what you heard from her was theory. Now here is the real world. You had a real live business owner or small business owner talking about how it's costing her more to run the business as well. She can't grow the business. She's having to charge higher for her services or product because it's costing her more to make or produce, right? And she hadn't paid herself three times, guys, and it's costing her more to live herself. But I thought the economy was roaring. It ain't making no sense. So here was a classic case of theory from the media and real world from a small business owner. Very clear thing to see. Ain't hard to see, guys. It's simple. Now, let's go over to the banking side now, guys. I just go to the banking side. All right, guys. You know me. Your pot is. I'm gonna bring the receipt. Let's go to it again. Now, let's go back over to the banking side and see what's going on with the banks. Because the banks right now, they ain't doing too hot as well, guys. Let's see what's going on with the banks. And then what happens once we've done that, and kind of what's going on with them. Here we go.
Stephen, let's start with you and the broader impact of what you heard yesterday on financials.
Yeah, good morning, Frank. I think for the near term, this puts incremental pressure on financials, on banks in particular. I think most of the companies we've been speaking to were hoping for more commentary around a pause as opposed to this, what sounds largely like a skip here, at least into July. So what we've heard over the last week is that most banks feel NII and NIM estimates from the street are a little too high. Wow. That deposit pressure has continued to increase in the past few weeks. While deposit balances have stabilized, that pressure on the cost has continued to escalate. So I think if this is truly a skip, that increases that dynamic and could put incremental pressure even on estimates for the sector into the back half of the year, even before we get to the potential for a recession.
So you hear at the end he just said a potential for a recession. Guys, come on, stop. We're in a recession. Let's stop playing the game. So now you're hearing from the banking side that they're feeling the pain. This is really from the small to regional banks, right? The big boys, the JP Morgan Chases, the Wells Fargos, the Citigroups, they're feeling it, but they're doing just fine, right? They're doing okay. They're doing just fine. It's those regional and small banks that's feeling all of this pressure right now. And it's just like what Red Pill just said right here. Red Pill said here, when it comes to the cost of goods from a consumer standpoint, 5 pounds of flour for $5.85. That's high for 5 pounds of flour. High. That's from a consumer. Let's go back to the banking side now. So the regional banks, although the depository balances are kind of stabilizing, they are still feeling the pressure for the cost of debt for themselves, guys, because the regional to the small banks, guys, they're not doing what the big boys are doing, the Wells Fargo and Chase is doing, which is actively trading commodities, things of that nature. They make the lump sum of their money lending out money to small business owners. That's how those regional and small banks make their money. They're not trading like the big boys. Let's keep it 100, guys. So now you're hearing that from a banking standpoint. What's going on here? All right, guys. So let's keep going to see exactly what's going on with this as well. Let's keep going. Here we go.
So you say there's potential for pressure, but when I'm looking at the KRE, it's actually month to date at least, it's doubled the market so far.
Wow.
So is that just simply bouncing off the lows, or have investors decided to rethink how they see the regional banking sector?
I definitely think it's been a recovery trade bouncing off those lows. I mean, we're still waiting for the generalist investors to come back into the group and kind of see what that catalyst is. They're
talking about investors not want to bring their capital over here. Why? Because the cost of the capital is too great. A lot of people point toward the bond or treasury bill yields, which is what the previous video pointed to. But guess what's happening is the Federal Reserve is just originating these bonds and treasury bills and then buying it for themselves. So it's fake. It's falsified success. And you're seeing this in the real world. Again, theory versus real world. Okay? Here we go. Let's keep it going.
The hardest part is trying to disprove the negative around potential credit issues.
Wow.
Whether that be CRE, office, et cetera. But I think the move we've seen so far has largely just been a recovery bounce.
All right, let's talk about the commercial real estate sector.
Here we
A
go.
lot of talk about billions of dollars in commercial real estate debt that's about to hit the market. How do you see that impacting these regional banks?
Listen.
Yeah, I mean, look, it's a massive overhang. I mean, we don't know what we don't know in terms of how weak this could become.
It's fake.
That being said, we do believe that a lot of the risk is outside of the banking sector today. We think that the dynamics in the market today are drastically different than they were heading into the great financial crisis.
Yeah.
You know, one of the numbers we looked at recently, over 60% of the office CRE that's on banks' balance sheet does not mature until 2027 or later. So it's a headwind. It's an issue.
Yeah.
There will be losses, no doubt.
Yes.
But it's not this, cliff where everything's going to reprice and re-rate to an 8% yield, this year. It will happen over time, and hopefully we get some relief as we move on.
So a lot of
so again, there we go, guys. There we go. Come on back to me. When it comes to commercial, we're looking at invest in hope. Hopefully it will kind of pan out. Hopefully we'll do this. And it's fine. It's good. It's good to have hope. No problem with it at all. But what I'm saying is the office space, the CRE, which is commercial real estate, what CRE stands for, guys, man, it's getting slaughtered right now. It's let's keep it a band. It's getting slaughtered. There's a reason why Elon Musk, when he bought Twitter, which is not X, the dude stopped paying the lease payment because he could to renegotiate the deal. Just stop paying it after he paid $54 billion for a company. Just stop paying the lease payment. Just stopped it because he could. But the commercial real estate industry, it ain't doing that bad. Man, please. Man, you know how we get so much good deals thrown at us from a commercial standpoint. I say no to them. Why? That space, the commercial real estate space for me, from an office standpoint, I don't want to touch it all. It didn't make any sense to me at all. Didn't make sense at all. Because why? The growth capital costs too much for companies, small businesses, which is what the bulk of those offices actually at least to. They can't afford to get the debt to get the debt to scale their businesses up because the cost of capital is too great. It's math. Again, invest in hope theory versus an actual plan, right? You're getting theory from the media. You're getting actual real world stuff from your partner. Again, theory, real world, you choose. Now, what deals are coming, guys? Simple. Wholesale deals are coming. So the buy and flipping is going to come as well. You can probably get some of that right now, flipping properties, but you have to get it probably at the right price point. The apartment complexes, man, because there's a lot of loans maturing, interest only loans maturing, right? And there's not enough revenue coming in from some of those apartment complexes, those B minus, C plus apartment complexes, which is really my sweet spot, to be honest with you. There's not a lot of revenue coming in there, and a lot of the landlords don't want it to improve the condition of the properties. So that's a big deal. Single family residences, guys, when it comes to really that luxury area, oh my word, if you know how to buy luxury the right way, guys, you can buy it at a below wholesale standpoint, increase the value, and then either flip it into an investor, or you can actually rent it out. The rental market, when it comes to the luxury market, don't sleep on that one. That can rebound as well also. The rental luxury market, because the cost of capital to acquire those luxury properties, who wants to borrow 8, 9, 10% interest of debt to buy a $1-2 million property? It doesn't make any sense at all. Would you? Hell, I won't. I wouldn't at all. But that's what's going on, guys. Now, what is a way, guys, for you to begin to no matter what happens with the market, how can you insulate yourself from a lot of loss, right? But also capitalize on the gain. Okay, even if you lack the knowledge to even locate the properties, if you lack the knowledge to manage the properties, if you lack the knowledge to raise capital for the properties, how can you do that? Right, that can insulate you from loss and mitigate your risk, but also increase your return on investment. Very simple, guys. It is joint venture investing. All right, guys. Here is part of the masterclass, guys. Here we go. We're gonna dive in this real fast. This is when you want to get your pen and pads out. All right. Here we go. Whew. All right. Joint venture investing to me is the most underutilized investment strategy in real estate I've ever seen. Most investors in real estate are solopreneurs. They invest themselves, and that's fine. Some people are really good at that. They're active investors, no problem. But being active in joint venture investing, guys, is so pivotal to do. I've made a lot of my money actually doing that. I own a lot of stuff on my own, but also I own a lot of stuff joint venture investing as well also, right? If you want to increase your return on investment as well as your buying power, joint venture investing is the key. Now, let's dive into this real fast. All right, y'all? Here we go. Here's today's agenda. It's very simple. We're going to talk about what is joint venture investing, right? Joint venture examples, active investing in the context of joint venturing, and passive investing in the context of joint venturing. All right, here we go. Here are some joint venture investing examples. All right, you have equity joint venture, you have contractual joint venture, consortiums, right? You also have, let me do this fast. You also have limited liability partnerships, LLPs, strategic alliances, and corporate joint venturing as well, guys. It's real simple, guys, what this is. Very simple. Now, let's keep it moving, all right? Let's keep it moving. Now, let's define what is joint venture investing. Okay, I'm always in the way. My bad, y'all. Here we go. Boom, here we go. Joint venture investing is very simple. Joint venture investing refers to a collaborative business arrangement where two or more parties pool their resources, capital, expertise, and efforts to undertake a specific project or business venture. In a joint venture, the involved parties work together to achieve a common goal, sharing both the risks and rewards of the venture. Very straightforward. Do you see just reading how this actually operates, guys? How you can really exponentially grow faster than being a solopreneur? Does that make some sense, guys? All right, let's keep it going, all right? Let's walk through each one of these joint venture examples, all right? Here we go. Equity joint venture. In this type, partners create a new entity, often a separate company, and each party invests capital and holds a share of ownership in the venture. Very simple. You guys have an investment together. You formulate a entity together. You guys actually invest the capital together, and you guys own an equity position in that joint venture entity. That is equity joint venture investing. All right. Boom. If you have any questions, put them in the chat. Contractual joint venture. All right. This involves a contractual agreement between parties to work together on a specific project without necessarily creating a separate legal entity. This is probably the most popular joint venture type of example because it's just a joint venture agreement. That's all it is. It's easy, concise, and it really itemizes out each entity or individual and what their responsibilities are. Very simple. This is probably the most popular one. All right. A consortium. This is probably the most unknown joint venture example. A consortium is a group of companies, organizations that come together to work on a specific project, often in areas like research, development, or large-scale infrastructure. Typically, large-scale investments are normally done via a consortium. Investors coming together and putting and investing their capital into say entity, and it's invested that way. Consortiums are normally done on an international scale. All right, this is probably the most unknown joint venture type of structure, so to speak. All right, let's keep it going. All right, limited liability partnership. All right, this is a form of joint venture where partners have limited liability for the venture's debts and obligations. It combines elements of a partnership and a corporation. It's a way. This is simple. It's another entity, right? But it's not an LLC. It's an LLP. It's the same thing. So it's just another entity formulated a little bit differently. This is probably the second most popular type of partnership. A lot of law firms are structured as an LLP. All right. So a lot of attorneys structure LLPs. That makes some sense. All right. Let's keep it going. Strategic alliances. While not a legal entity like a joint venture, a strategic alliance involves two or more companies. Now you have entities kind of together, collaborating on a specific project or business activity for mutual benefit. So all it is, guys, is just really a joint venture agreement. Be honest with you, instead of individuals, entities. That's all it is. That's called a strategic alliance. Very simple, concise. All right. And then here's the last one, cooperative joint venture. This type involves the sharing of resources and risk among partners to pursue a common goal. It's often seen in industries like agricultural and manufacturing. Yes, that's all it is. It's cooperative joint venture. Entities getting together. That's all it is. And it lets you know it's mostly done in the agricultural and manufacturing arena. If that makes some sense. All right, guys. Now, let's dive into the different type of investors. All right. You have the active investor. All right. Each investor has a goal. This is the active investor's goal. It's an individual or entity that takes a hands-on approach to managing their investment portfolio. They are actively involved in making decisions about which securities or assets to buy, sell, or hold. Active just means that you're hands-on. You're doing day-to-day operations. Look at the mission. The mission is to buy, sell, or hold assets. Simple. The vision, managing and growing investment portfolio. And the goal, guys. Let me get out the way real fast, guys. And the goal is very simple. The goal is to what? Generate a good rate of return. Simple. Just an active investor is active involved in the day-to-day operations. They really want to build a business. They want to be that business themselves and be actively involved in that business. And there's nothing wrong with that at all. I'm an active investor. I'm an active investor in one of my entities, right? I am. It's just what it is. That's fine. Now, let's go on to the next one. All right. Here is a passive investor. Let me make it bigger for you guys real quickly here. A passive investor, their goal is an individual or entity that adopts a relatively hands-off approach to managing their investment portfolio. Instead of actively making frequent trading decisions, passive investors typically focus on a long-term strategies and aim to achieve returns that closely mirror the performance of a particular market index or asset class. Passive is somebody that's just hands-off. They're hands-off. They're really hands-off. They just want to just kind of mirror what's going on in the market index or asset class. That's all they are. Very simple, guys. But it's the same. Look at the mission. Same mission as an active investor: buy, sell, or hold assets. Right? Managing and growing investment portfolio passively. Right? And generate a good rate of return. Again, passively, hands off. Different, because they don't have the time to do it from an active standpoint, if that makes some sense, guys. Now, which option is best for you? The only person asking that question is you. Do you want to be an active investor who is involved in the day-to-day hustle and bustle of investing in real estate? Or you want to be more of a passive person? Hey, you know what? I'd much rather do one of these joint venture agreements, one joint venture structures, to where I can generate a great rate of return and I can mirror the performance of a market or asset class. It really depends on what you're trying to do. The only person to answer that question is you, guys. Well, guys, man, I hope that helped you out. I told you this is going to be a little bit more of a masterclass. I'm going to take more of a masterclass type of approach, guys, moving forward, because of the fact that I think that man, to be honest with you, I could teach you a lot more, give you a lot more value with this type of setup. So don't be alarmed if you see a lot more of these type of presentations kind of break down an investment strategy. All right, guys? Man, guys, give me your thoughts. What do you think, guys, what we talked about, man? When it comes to what option is best for you, hey, I'm the person asking that question is you. If you want to talk to me about which option works best for you, if you look at the comments below on any one of the platforms, you'll be able to see. Click on the link, and there's a little short presentation on the top 3 investment strategies in 2023 and beyond that I'm teaching. And you can schedule time to talk to me or Cliff or someone on the staff about what works best for you, and we can point you in the right directions. It's real simple. We have a QR code next week for you to kind of scan. But we get this question a lot of times. Hey, LaDale, I want to be an active investor. Hey, Dad, I want to be a passive investor. Which one should I choose? Well, you saw the presentation on the different JV structures, what an active investor is and a passive investor is, right? And so now you can then begin to understand what you would like to do. It's very simple, guys. But guys, thank you so much for your time, guys. Next week, Cliff will be back on there. And guys, we do have the Real Estate Masterclass coming. Oh man, I can't spell today. I'm going to get rid of that T. My bad. But we do have the Real Estate Masterclass, guys, coming this month real soon. We'll be announcing that date next week, right? It's going to be before Thanksgiving, right? So be ready, because the last Masterclass, man, we killed it. We killed it, guys. We killed it. So we'll let you on the next Masterclass, guys. Reserve your spot. We only got to reserve a certain amount of seats. Reserve your spot, guys. But guys, thank you so much for your time. God bless you. I hope I added some value to you today, man. But you know how I ended every single time, guys. Before you leave, and while you can, you see that thing, take that down picture and give it to your mom and them. And say it with your chest and holler at your partner. All right, guys. Peace.
God give thanks. Whoa. Bless God, give thanks. Bless God, give thanks. Whoa. Bless God, give thanks. Whoa. Big God, big grace.